Rahul Chadha joins us. Let's say hello and welcome. Let's say welcome him to our studio. What brings you to India?
Yeah, so I think it's those regular channel checks. Every quarter I'm in Asia, so a week in India and then a week in Hong Kong. So next week
So you're
onwards.
investing in China and India.
Yeah, Asian market.
And what
But
is
all
it?
the action is in the US now with Trump taking oath and all the chatter on calling Gulf of Mexico, Gulf of America, joining Canada to the US.
Indeed.
What's happening there?
So I think clearly, like the way you said, there is going to be a lot of chaos which is going to come at us in the coming months. Our sense is, look, over next 6 to 9 months, people will question the American exceptionalism. Everybody is happily invested in the US. They made a lot of money. If you look at the Ps, historical Ps, etc., the market is expensive. And I think that's where the hope is for emerging markets over the next 6 months. Valuations are the cheapest it's been in the last 40 years.
But I've heard that a year ago. I've heard that 2 years ago that US accounts for nearly 50% of the market cap. The debt to GDP ratio is an alarming level. It has to go down. But that Ruchir Sharma argument from last 5 years, if I may use that line, has not made any sense.
No, I think what happens is, it's typically, I wouldn't call it a bubble, but when people actually give up and everybody is complacent about it, that's how markets correct. See, I'll give you a different example. We talked about Indian markets in September. People said, look, these markets would not correct, and look at the correction which came in October. So markets have a habit of surprising. Just when everybody is complacent, they suck everybody in. You get an outcome which surprises everybody.
So by that logic, China should have gone up.
So I think what happens is China would be an interesting market to watch over next 2 years, and I'll give you a framework for that. And I think the point is we're not going to get the 60% tariffs. See, again, Trump wants to leave a legacy in his second term. So a lot of this noise which you see is rhetoric ahead of negotiation, ahead of deal making, etc. So what you're going to see is very specific tariffs on things which can be manufactured in the US. They're also mindful of the US inflation. They're also mindful of the bond yield. So they don't want to derail the US story. So as the tariff outcome is much kind of a benign than what is expected, people will go back to China. And what we've seen over the last 5 years is Chinese companies have done a good job. You look at what they've done in EVs, what they've done on the solar side, what they've done on consumer electronics, companies like Xiaomi, etc. So I think there are a good bunch of companies, and these companies are trading at a fraction of valuations in the US.
But Rahul, we believe that the last time we interacted with you, you were underweight India, and you also believe that in the next 6 to 9 months there could be some bottoming out in the place. So any change in that rationale?
So absolutely. So I think in the correction which happened in India, we added 2 Indian large caps, the IT pharma. And again, we'll maintain our bias towards large caps for next kind of an 5 to 6 months. But in this period, you get an opportunity to add to mid caps. So there are good mid caps in industrials, in consumption, in financial services space which are attractive. These names have done exceptionally well over the last 3 years. So it is but natural for stocks which have gone up 3, 4, 5x over 3 years to take a breather. I mean, markets or stocks don't go up every day. So I think that's what we've got to understand, that look, the Indian markets will go through a period of time correction, particularly for some of these small mid caps. But the longer term story is intact. I mean, look, very few economies in the world are growing at 5 to 6% plus. This is real GDP. You add 3-4% of inflation, that's a 10% nominal GDP. So I think that's a very interesting proposition. Government's fiscally prudent, so that's attractive. Currency is being stable. The forex reserves are good, and all these things matter from a medium-term perspective.
But you think the dollar strength is the biggest enemy right now, which is why the FI money won't be in a hurry to come back to India, even though the valuations maybe a lot more attractive than they were 6 months back?
Absolutely. So everybody is looking at the US 10-year yields, and I think that's what's keeping fresh allocations at bay. People want to see whether you have these US 10-year yields which are about 470 now going to 5%, and that derails the global equity story. See, there is an angle to it, which is the productivity which comes because of the AI. So once you have that kind of a productivity coming through, once you have softening of US economy, look, most global economies have softened coming out of COVID as the governments cut back on the deficits. The same thing happens in US this year. Some of the savings get utilized. So as US slows down this year, the bond yields would also ease off in this.
Is that simple? Yield goes down, money comes to emerging market, dollar goes down, money comes to emerging market. I mean, if that was Investing is not that simple, right? We get up in the morning and say, okay, yields are up, India will go down. Dollar is up, India will go down. Is that simple?
So I think because that is not the only factor.
Make it sound very simple.
No,
right? It's
see,
not that simple,
that's
right?
not the only factor. That's one of the factors. See, also it's a function of positioning. See, if you've got people who've taken money out for last 6-9 months, and we talk to investors, and everybody's kind of underexposed there. People look at their portfolios. 70-80% of their portfolios in US. Increasingly, they want to diversify. They want to allocate out. But nobody wants to allocate ahead of this tariff uncertainty. So the mindset here is in 2016 also US peaked when Trump came, when the inauguration happened. Near-term peak maybe around next Q1. And if you don't see worst of the tariffs kind of a play out, currency depreciation also gives good interest.
I give this example to everybody that 2016, Donald Trump comes back, markets go down. We don't know what Trump could do. 2024, Donald Trump comes back, markets go up. The same personality has attracted two different reactions, right? Right.
Yeah.
So what is right, what is wrong, I don't know. All I'm
Yep.
saying is that the same personality has attracted two different reactions. So will it be different that in 2016, a Trump comeback or Trump first time election had an impact on the negative side. And then ultimately market realized that, look, it's going to be a very sober kind of a regime, and markets went up.
Yeah.
This time could it be different, which is that markets have already rallied in anticipation of to what he will do, and then there could be a sell on, buy the rumor, sell on news kind of template?
Yeah, so we've seen the US markets rally on this. See, if you look at the US macro funds also, how are they positioning? Again, they short the EM currency. So that trade reverses. See, from September onwards, you had people shorting Korea, people shorting whatever, the EM currencies. That trade gained all the more traction in November, December. So which is where my point is that, look, again, in 3 months from now, that trade would have kind of outlived this whole utility.
All right, but Rahul, also help us with your take on Reliance as well, because today we have two of the notes coming in. Bernstein is also debating that they believe that 2025 will see a recovery cycle. What is your take on Reliance? That 2025 is going to be of the big boy Reliance?
So I think what weighed the stock down last year was that retail was subdued. So we saw that some of the stores were getting closed, and retail was a significant part of the value, etc. So as you see that impact kind of wear off and numbers pick up for the consumption part, there is a trigger in terms of talking of the Jio IPO, etc. That should be there. The stock's attractive. It's gone through a period of underperformance, obviously. And look, it also got impacted because of ETF or in terms of FI outflows from India. So as kind of a funds come back, I think this is a good name, and from a valuation perspective, risk reward is favorable here.
You talked about IT and pharma. Let's pick up on IT first. Would you go by the traditional IT services plays, or would you say IT tied with AI is where the better growth and value is?
So you will see the traditional IT services plays embrace AI. So if you look at what these likes of Infosys, TCS, Cognizant are doing, these are embracing AI to offer better value to their customers. So this is superior data analytics. So a lot of pilots are happening. Our sense is the next stage over next 2-3 years is going to be these pilots, pilot projects going into large scale commercial projects. And that's where the benefits is. If you look at how top 100 corporates globally has embraced AI, it's phenomenal. I mean, we've seen papers all over talk about Microsoft's capex, which is $80 billion for next year, and they're investing in India. But they're not alone. You've got Facebook doing the same, Google doing the same thing. More importantly, I think the top 100 corporates are taking AI spends as a part of their R&D productivity spends. And you can buy all this capacity, computing capacity at the Microsoft servers, but the customization has to be done by the IT services guy. And I think that's the opportunity here. And they also benefit from rupee depreciation, etc.
So let's look at IT, and I'll put the template here. Best case scenario, 8% growth. That's the best case scenario. Realistic scenario, 6.5% growth. 2.5 to 3% dividend yield. And these stocks are trading at P multiples which are anywhere between 20 to 30 times depending on the estimates you look at. Is there merit in buying a sector or a stock which is growing at 6 to 8% and available at a P of 20? Because there is a long list of other companies which are available at P multiple of 15 and growing at 30%.
So I think it is market always trades the delta, the relative earnings. So if we sit today, you have IT pharma, which are kind of an outshining the rest of the pack in terms of the earnings. And we know a secular business will also go through mini cycles, etc. And I think that's where the case for IT comes. In IT, what we particularly like is something like Cognizant Technologies. So to what you said, Cognizant is trading at 16, 17 times. So that's a name where a turnaround is happening. So that's where you've got to go beyond the obvious and do a bit of an deep work and see where there is value. But
anything in the product space, anything, because now a whole host of SaaS companies have gone public. You've got, let's say, a company like MapMy India, which is a product company. You've got a lot of other companies which is in a sense are specialist companies. Do you like anything in that space? Because every week 2-3 companies are going public now.
See, one needs to watch these companies for a while. Again, they don't have a long kind of a history here, and the valuations are not cheap. See, one is also mindful of not paying 40 times here, where you've not seen the management track record for a reasonably long period of time.
Rahul, what is beyond the obvious when it comes to pharma then? Because though India is known to be the pharmacy of the world, but do you still like the traditional pharma companies, or now the focus is on the CDMO side? Maybe that's the segment where we need to show the mettle.
So I think opportunity comes again both in traditional pharma, CDMO and hospitals. See, hospitals are particularly names we've invested in last 5-6 years. They've done well. Again, go through a breather for a couple of quarters, but the demand story is secular. You look at the numbers of diabetic patient, the cancer patient in India, those are humongous numbers. And again, people have willingness, propensity to pay, insurance coverage is better. So that's where the hospitals is. For pharma, the story is that, look, in the past, we saw a significant erosion in generic drug pricing in the US. That's not happening. So the capacities are limited over there. And a lot of these pharma companies are smart. So there is talks of some of them kind of going into the GLP-1 opportunity in next 2-3 years in markets like Canada, etc. So those can be additional triggers for these pharma companies. So good growth stories, secular growth stories. Again, one has to be mindful about valuations. One's got to be mindful of the fact that the companies one is invested in do not have significant one-off or are not riding on significant one-off opportunities. So that comes with it. Lastly, to your point on, again, contract manufacturing, see, China plus one is real. You're going to see, and look, if you are a buyer, you would not buy 80% or 70% of your requirements from one supplier. Unfortunately, what happened was the experience with China was so phenomenal that that's what most kind of our customers ended up doing. But now when the geopolitical risks come to the forefront, they would diversify. And I think that's where Indian companies kind of a benefit. What one's got to be mindful of is that, look, initially the pricing may be impacted because there would be competition. Yeah.
Now tell me, how much of the entire premium consumption story has already played out and across categories, be it autos, real estate, FMCG, retail, all of it? Or do you think right now what makes more sense is to have those exposure in your core portfolio, but the alpha generation is going to come in from the rural place because that's where valuation comfort is?
Yeah. So I think what would happen is premium kind of consumption categories like travel will continue to do well.
Yeah.
So we've seen that. You look at around us, in your friends, family circles, etc. Everybody wants to travel out, and there is a wealth effect and there's a propensity to do that. So again, hotels and things like Make My Trip, etc. are the big beneficiaries of that. We've seen a bit of a breather in premium consumption, but some categories like jewelry is done well. To your point on rural economy plays, I think that's something one's been waiting. That look, the pressure which came from inflation post-COVID has eased off and incomes have improved, economies have improved. So the hope is that some of these two-wheelers or consumer staples should do well in the coming quarters.
The FMCG index in last 1 year has given a flat return. The private banking space has given a flat return. But if FI selling continues, will they give any returns? Because large part of the market is, at least that area, is still dominated by foreign institutional investors. So HDFC Bank may be cheap, but it could remain cheap. HUL is expensive and it could remain like this for a long period of time. That's my only worry, that if FIs they continue to sell, the supply is going to be unrestricted.
Okay. So on the banks, I would have a different view here, Nikunj. What I'm saying is, look, our basic thing which we're discussing is that 6 months from now, you may see these outflows change to inflows. And the valuation for banks again will become attractive. Globally, if you see, banks have done well. because there's a reflation trade. Inflation being high is good for banks. You look at the performance of Bank of America, the US Bank, Citigroup, etc. They've done exceptionally well. Same with Hong Kong banks. Names have come back, credit growth has come back. So there's no reason that should not happen in India. There was a pain over last 1 year which came because unsecured lending was under controlled. That had impact on NIMs, that had impact on delinquencies. I think that's going to go off in a couple of quarters. For companies like Hindustan Unilever, I think there is a different set of issues. That is the issue that the new cohorts of consumers are probably not identifying with those companies. You see huge amount of competition which has come from new kind of companies, personal cosmetics, etc. You look at the growth, the new companies are getting at the kind of a sake of Hindustan Unilever. So I think those are business issues one has to see. For other consumer names like Asian Paints, it's more of a competitive intensity than anything else. So I think those are more of a company or a sector specific issues.
What are those big structural stories that you would continue to stick by with when it comes to India? Any sectors or stocks?
Yeah, apart from what we discuss, I think this whole manufacturing, this whole industrialization, this whole investment in the power capex is a real story. See, we are seeing it globally. The demand for power and infrastructure rollout has improved significantly, and outside China, not many countries had invested in this space for last 10 years. So I think that's something one would like to buy on everyday clients. As you see currency stabilize, as you see economy kind of and stabilize, rate cuts coming through, I think industrials becomes an attractive story. And then exporters. See, what would happen is right now a lot of these exporters are facing competition from China and their realizations are impacted. But over next 2 decades, you will see more and more kind of benefits coming from the China Plus One. So you've got to look at exporters across categories.
You know, I'll just wrap it up with one point which I was watching a address by N. Chandra at one of the colleges, and he said that energy cost in the world is still very high, and I expect that energy cost will keep on coming down successively every year. It is still very high. We say that 3 rupees a unit, 2 rupees a unit, he feels that's still very high. So for me, if energy requirement is only going to increase because productivity level, AI, everything will consume more energy, that means energy cost has to come down. So go for anything which has got to do with energy innovation. Now, whether it is a meter company, wire company, solar company, power company, that's a debate we'll have some other time. But that's just food for thought. I thought I'll tell you the mood in India, what corporates are doing.
Yeah, no, absolutely. That's good. Always nice to be with you guys. Yeah.
Right. Have a great year ahead and thank you for joining us.
Thank you. Thanks for having me.
Now, what we are discussing is that we are discussing.
If you like this video, then like, share and subscribe to ET Now.